Okay, so this question deals with the issue of a deceased estate. And what do you do with property that is transferred out of that deceased estate if the deceased estate was a VAT vendor? Now, just going back to the basic principles, an estate of a deceased person that is a VAT vendor is regarded as being continued by the person that administers the estate. So the estate and the person is deemed to be one and the same person. So if the enterprise is continued, the estate just is continued as well. And the state then takes over all the obligations of the person that was the vendor before. So if you then continue with that enterprise, the enterprise will be a normal VAT enterprise. Any supplies out of that enterprise will be subject to VAT, and anything purchased into that enterprise will be subject to input tax. But now the person that administers the enterprise, the executor of the estate, has the option to continue with the enterprise or discontinue the enterprise. So if the enterprise is discontinued, then normal Section 8(2) adjustment is made. In other words, all assets are regarded as being disposed of at that point in time at the lower of cost or market value, when the enterprise ceases being an enterprise for VAT purposes. But let's assume for the moment, and it seems like this is what this question leads towards, let's assume for the moment the enterprise continues on and the distributions out of the enterprise is done by the executor of the estate. So if the executor of the estate does a distribution of a property out of the estate, and the property is owned by the VAT enterprise, part of the VAT enterprise, that is a supply for VAT purposes. And then the only issue is it a supply for no consideration, which it normally would be, because you don't pay for inheriting something, or is it a supply which is subject to market value rules? Now, the market value rules only apply where the person that receives the benefit or the goods and services, where that person is a connected person in relation to the estate. So if that person is a connected person, then that supply for no consideration will be deemed to be made at market value if the person that receives that asset will not be using that asset in an enterprise activity. So if that person that receives the enterprise, let's take an example. Let's say a farm is transferred, and it's transferred to a person that will use that farm as a VAT vendor in the course of the enterprise carried on by that person. That person will be entitled to an input tax deduction if a consideration had been charged. Under those circumstances, the deeming provisions in terms of deeming that supply to be at market value, those provisions do not apply, and it's a simple supply for no consideration, is no VAT consequences. If, however, the person that receives that farm will not be carrying on an enterprise, so they'll simply stay there, they won't be operating the farm as a farm or as a business, then had that person purchased the farm, would not be entitled to a full input tax deduction, which then means the deeming provisions come in if that person is a connected person in relation to the deceased person. Then that supply is deemed to be made at market value, and that supply would then be subject to VAT on that basis. Actually quite simple, but it is important to understand how the various flows of transactions take place, and of course have an understanding of who the recipients are and what that relationship with recipients is with regards to the testator. Once we've got all that in place, the VAT consequences almost naturally flow from that. Hope that makes sense.